A famous short seller just declared war on Palantir, calling its valuation absurd and predicting a crash down to $40. Then it happens. Palantir is suffering from a 5-day losing streak, down $30 from its high. So, what the mew is happening here? Look, if you only have a minute, or you don't want to listen to a random guy hiding his face in a tiny channel, here's the main thing you need to understand. The entire short argument hinges on comparing Palantir to OpenAI, and that comparison is fundamentally broken. It's like valuing a custom car manufacturer based on the price of one of its engine suppliers. It just doesn't make sense, and I'm going to show you exactly why, along with the technical picture in the next few days. Hey, for those of you who are new here, my name is DataCat. Let's just say I spent enough years as an analyst inside a big Fortune 50 company, staring at messy data until I ran out of coffee. I traded that life for this. A keyboard and a laser pointer for my actual cat, who seems to think return on investment is how many times he can knock my pen off the desk. My goal with this channel is pretty simple. I want to cut through the noise that Wall Street creates, the kind of noise that is specifically designed to make the regular investor panic sell. So if you're interested in analysis that goes a little deeper than a scary headline, maybe consider subscribing. It's just a click, it doesn't bite. Unlike my cat, who absolutely does. Alright, let's set the stage. The protagonist of our little drama is a firm called Citron Research, run by a man named Andrew Left. They are what's known as an activist short seller. Now, what does that mean? It means they don't just bet on a stock to go down. They actively try to make it go down by publishing research that exposes what they see as major flaws in a company. And on August 14th, they set their sights on Palantir. After the stock ran up an incredible 144% this year, Left went on television and said he was betting against it, calling the valuation absurd. Then a few days later, on August 18th, the official report dropped, and it had a headline-grabbing price target, $40 a share. The market, of course, reacted. The stock dropped 6% almost immediately. Fear is a powerful motivator. So how did they get to that $40 number? This is the part they want you to focus on because it sounds simple and logical. Their entire case is built on a comparison. They take what they call the most generously valued AI company out there, OpenAI, and use it as a measuring stick for Palantir. The math looks something like this. They project OpenAI will make around $30 billion in revenue by 2026. In that same year, they see Palantir making about $5.6 billion. Then they take OpenAI's price-to-sales multiple, which is 17, and they call that insanely high. They apply that same multiple to Palantir's smaller revenue number, do some division with the roughly 2.4 billion shares outstanding, and voila, you get a price target of around $40. It's clean, it's simple, and it's designed to scare you, but it's also deeply, deeply flawed. The first and most important mistake is the comparison itself. Comparing Palantir to OpenAI is a rhetorical strategy. It's not a serious financial analysis. Why? Because they do fundamentally different things. Think of it this way. OpenAI builds incredibly powerful engines. They're large language models. They are world-class at it. Palantir, on the other hand, builds the entire custom vehicle. They build the chassis, the security systems, the dashboard, the entire operating system that allows a massive organization to function. And then they let their client drop in the engine of their choice, whether it's from OpenAI, Google, or one they built themselves. Palantir's core value isn't the language model, it's the ontology. That's a fancy word for a map that connects all of a company's messy, scattered data into a single usable model. They've been doing this for almost 20 years. The LLM is just the newest, shiniest interface for their powerful underlying platform. So, Citron is valuing the custom car manufacturer based on the price of the engine. Does that sound right to you? It's like trying to value a house by only looking at the cost of the kitchen faucet. It's absurd. Next, let's talk about that 17 times price-to-sales multiple they call insanely high and the highest in the world. That's a stretch. It's a narrative tool. While 17 is not cheap, plenty of high-growth tech companies, especially in AI, have traded at multiples of 25, 30, or even higher when the market is optimistic. Mind you, I'm not saying these companies are cheap. The entire industry is expensive. It's just that they are picking a metric and framing it as the absolute ceiling to make Palantir look like an extreme outlier. They're just not showing you those other comparisons. You also have to look at when they released this report. This wasn't random. Activist short sellers are masters of timing. They waited for a perfect storm. The stock was already hitting a wall around the $200 level. The broader market was getting nervous because of the Fed and weak economy, which I've already warned about a couple weeks ago. And historically, August and September are weak months for stocks anyway. They didn't just find a wall, they found a wall that was already leaning, and they gave it a hard shove. It's a deliberate move to create maximum psychological impact and accelerate the selling. And this brings me to what I believe is the real game here. That $40 price target? That's marketing. It's the headline that gets clicks and spreads fear. A short seller doesn't need the stock to actually hit their public target to make a fortune. Think about it. If they started shorting around, say, $185 and their report helps push the stock down to $150 or $140, they can just close their position and walk away with a massive profit. The target is the story. The trade is about capturing the momentum their story creates. Finally, it's always useful to look at a firm's track record. Citron has made some great calls, but they've also had some spectacular failures. The most famous one, of course, was their short position on Tesla. They underestimated a company with a powerful long-term story and a very, let's say, loyal investor base. Sound familiar? This just shows that their reports are not prophecies written in stone. They are a market catalyst, a very powerful one, but they are not the final word on a company's value. Alright, so we've picked apart the story that Citron is telling. But a story is just that, it's a narrative. As an analyst, I learned you have to trust the data more than the narrative. So let's push the story aside and look at what the chart is actually telling us. And I'll be honest with you, the immediate picture is not pretty. The sellers have been in absolute control for the past week. Look at this last candle here. The stock dropped 9.35% in a single day. But the really important part is the volume. The number of shares traded was more than double the average. That's a major red flag. This isn't just quiet profit-taking, this is aggressive, high-conviction selling. Some traders call this a power candle for the bears, and it's a sign of force. At the same time, the momentum has completely collapsed. The RSI just a week ago was up at 80.24, which is deep in the overbought territory. Now, it has plummeted to 43.78. That is a massive and rapid loss of speed. A similar indicator MACD also seems to show the bearish momentum is getting stronger. And you can see here the price has sliced right through its 20-day moving average, which was at $169. Think of that line as the first line of defense in an uptrend. Well, that defense has been broken. This wasn't a one-day shock either. It's been a 5-day losing streak, a sustained period where sellers have just overwhelmed anyone trying to buy. So that's the bearish case. It's immediate, it's violent, and it's what the headlines are focused on. But if you only look at that, you're missing the bigger picture. You have to zoom out. Despite this brutal sell-off, the longer-term uptrend is still structurally intact for now. The price, which closed at $157.75 during market hours, is still comfortably above the 50-day average, which is around $152. And more importantly, it's way above the 200-day average. The golden cross, a very strong long-term bullish signal, has been active for nearly a year. The underlying trend is still up. But this is the most critical piece of data on the entire chart right now. The closing price of $157.75 is sitting directly on top of a key technical level at 0.618 Fibonacci retracement, which is at $157.48. Now, without getting too technical, this level, often called the golden ratio, is one of the most significant potential support zones in trading. It's a level where algorithms and big money traders who have been patiently waiting for a pullback will often step in to buy. It's Well, it's where you'd expect a bounce to happen if the uptrend is still healthy. My cat actually tried to help me draw these lines earlier by walking on the keyboard. I think his came out a little more abstract. So what does all this mean? The data tells a story of a stock that got way ahead of itself. The RSI being over 80 told us it was vulnerable. The Citron report was simply the catalyst that knocked it over. The current price action is a test. It's a test of the long-term bull's resolve. The fact that this massive, panic-driven sell-off stopped almost to the penny at the most important Fibonacci support level is not a coincidence. So, here are the key levels you need to watch. This is where the battle will be won or lost in the coming days. The first critical support zone is right where we are, around $157.50. If the price bounces around here, it would be a very strong sign that this was just a sharp but healthy correction. If that level breaks, the next major support, the real line in the sand for the medium-term trend, is the area roughly around $150. That's where we find the 50-day moving average. A decisive break below that level on high volume would be a major victory for the bears. To the upside, for the bulls to regain control, they need to push the price back up and reclaim that 20-day moving average around $169. That will be a tough fight. So we have a classic conflict. A powerful, fear-driven short-term downtrend is colliding with a very significant long-term support level. The rest of this week is crucial. It's going to tell us if this is just a healthy shakeout, the kind that washes out the fear and sets the stage for the next leg up, or if the bears are going to press their advantage for a while longer. But as we already discussed multiple times, this pullback was triggered by a perfect storm of seasonal weakness, macro fear, and a very well-timed short report. For a long-term investor, a test of these key support levels isn't necessarily something to fear. It can be an opportunity. It's a chance to see if the underlying strength of the company's trend holds up under pressure. If you want to see how this battle between the short-term fear and the long-term trend plays out, and get more analysis that cuts through the noise, make sure to hit that subscribe button. It helps the channel out more than you know, and you won't miss the follow-up. Thanks for watching. DataCat out. Stay sharp and stay safe out there.